You're staring at a rather baffling number on an insurance document. Next to it, the word deductible, or perhaps excess. The insurer promises to pay you vast sums if disaster strikes, but they've also quietly inserted this irritating little financial speed bump right at the start. It's perfectly understandable to feel a twinge of suspicion. Most people suspect it's merely a cunning trick designed to cheat them out of their hard-earned money. I dare say it's enough to make a gentle soul retreat to the deepest, darkest woods and give up on civilization entirely. Allow me to explain. Once you tear away the impenetrable jargon, a deductible isn't a trick at all. It's simply the initial slice of a bill that you've agreed to pay out of your own pocket when something goes wrong. The insurer only steps in to settle the rest of the account after you've handed over that specific first chunk of cash. Think of it as a sturdy drawbridge. You're responsible for lowering your own defenses and handling the immediate, minor onslaught before you can call upon the reinforcements waiting in the castle keep. Let's build this from the ground up. Suppose you're driving your motorcar and you've a slight, entirely regrettable disagreement with a lamppost. The resulting damage to your vehicle requires $1,000 to repair. Now, if your insurance policy carries a deductible of $250, the mathematics is terribly straightforward. You'll hand over the first $250 to the mechanic, and the insurance company will graciously provide the remaining $750. The transaction is utterly simple, yet it's vital to grasp precisely why this strange arrangement exists. The deductible wasn't invented solely to torment you. It serves two rather important functions. First, it prevents the entire system from collapsing under the weight of ghastly petty claims. If insurers had to process a mountain of paperwork every time someone got a tiny scratch on their car door or lost a single shingle in a mild breeze, the administrative cost would bankrupt the industry. Premiums would immediately shoot toward the moon. The deductible acts as a rather sensible filter, ensuring that an individual only makes a claim when the damage is genuinely serious enough to warrant it. It forces you to pause, look at the cost, and ask yourself if the matter is truly worth reporting. Second, a deductible encourages you to behave rather well. If you're entirely insulated from any financial consequence of a clumsy mistake, you might not take adequate care. You might leave your front door wide open or drive far too aggressively. Because you know you'll have to pay that first chunk yourself, you're naturally incentivized to avoid the disaster altogether. This aligns your interests with the insurer's interests, which is exactly how an effective financial partnership operates. Now then, you'll often be offered a choice when you purchase a policy. You can opt for a higher deductible or a lower deductible. This choice fundamentally alters the price of your monthly bill. Insurers call that monthly bill your premium. If you choose a high deductible, you're agreeing to take on more of the initial financial risk yourself. Because the insurer won't have to worry about paying out for minor incidents, they'll reward your bravery by giving you a significantly lower premium. Your monthly costs will be quite small. If you choose a low deductible, the arrangement flips entirely. You're asking the insurer to step in much sooner and take on far more of the financial burden. Naturally, they'll charge you handsomely for this privilege. Your monthly premium will rise, but your out-of-pocket expense at the moment of a crisis will be reassuringly low. It's a delicate balancing act between what you pay every single month for peace of mind and what you can comfortably afford to hand over on a terrible Tuesday afternoon when disaster strikes. This is why you mustn't choose a high deductible merely to secure a cheap monthly bill. If you select a deductible of $2,000 because you're chasing a tiny premium, you must be absolutely certain you actually have $2,000 readily available. If the lamppost attacks your car and your bank account is entirely empty, that high deductible becomes a dreadful trap. You won't be able to pay your share, the mechanic won't fix your car, and the insurer won't pay a single penny until you do. The deductible isn't just a number on a page. In areas prone to extreme weather, you'll frequently encounter what is known as a percentage deductible. Instead of a flat fee, your out-of-pocket cost becomes a percentage of your home's total insured value. If your house is insured for $400,000 and your windstorm deductible is 2%, you don't just owe a trivial sum. You owe $8,000 before the insurer will contribute a single penny to the repairs. you must read your documents with great care to ensure you know exactly what type of deductible structure you're signing. This brings us to a rather common point of confusion regarding how these payments actually function. People often become distressed because they believe they must pay the deductible to the insurance company directly. They wait anxiously for a bill that never arrives. But generally, you don't pay the insurer. You pay the mechanic, the builder, or the medical provider. The insurer simply calculates the total approved cost, subtracts your promised contribution, and funds the remainder. If you're dealing with a routine repair, you might pay the entire bill yourself if the final cost ends up being lower than your deductible. If your car needs $400 of work and your deductible is $500, the insurer pays nothing. You handle the whole affair yourself. Understanding this mechanism completely changes how you should view your insurance coverage. You don't want to use your insurance for minor, manageable incidents. If you scrape your door and it costs $600 to fix and your deductible is $500, claiming it's rarely a wise move. The insurer would only pay $100 on your behalf. In response to making this small claim, they would almost certainly raise your monthly premium at the time of your renewal, effectively punishing you for using the service. You could end up paying that $100 back to them several times over through increased monthly costs. For minor scrapes and bumps, it's often far wiser to simply pay the mechanic directly and leave your insurance entirely out of it. There's also a vital difference between deductibles and co-pays, though I shan't dwell on this too deeply as it borders on tedious. A copay is a small fixed fee you pay every single time you use a service, like paying $20 every time you visit a clinic. A deductible, by contrast, is a cumulative threshold you must satisfy entirely before your insurance kicks in to cover the broader costs. It's a milestone you've to hit. Once you've paid enough to meet that milestone, the insurer takes over the heavy lifting for the remainder of that specific incident or policy year. So we arrive at the grand strategy of selecting your own deductible. The choice itself is a reflection of your personal financial resilience. If you possess a robust savings account and can comfortably absorb a sudden, unexpected expense, you should absolutely opt for a higher deductible. Doing so will radically reduce your monthly premium, saving you a tremendous amount of money over the years. You're effectively betting that you won't need to make a claim, and you're keeping the money that would have gone to the insurer right in your own pocket. Conversely, if you live month to month and a sudden $1,000 bill would utterly ruin you, you must choose a lower deductible. Yes, you'll pay significantly more for your premium every month. But when disaster strikes, you won't be left stranded. The insurer will step in almost immediately. You're paying a premium for the comfort of knowing your immediate out-of-pocket risk is tightly controlled. The entire system is remarkably logical once you see the gears turning behind the curtain. It's simply a shared burden, carefully calibrated to keep the machinery of risk functioning smoothly without punishing anyone excessively. It discourages frivolous claims, encourages careful behavior, and allows the insurer to calculate their own exposure with reasonable precision. When you next look at that baffling document, you won't feel a cold sweat. You'll see the drawbridge for exactly what it's, and you'll know precisely how to manage it. I'm awfully curious about your own strategy. When you're faced with the choice on an insurance form, do you typically favor a higher deductible to keep your monthly costs down, or do you prefer the comfort of a low deductible? Do tell me in the comments below. If this cleared some of the fog around your insurance, do pass it to somebody who still treats their policy like a foreign language. A quick like on your way out simply tells the machine this was worth making, nothing more. And if you'd like the next teardown to turn up on its own, the subscribe button will see to it.